Welcome to the Deep Dive. We're your guides for breaking down the big financial events.
That's right.
And today, we are diving into Bank of America, specifically their second quarter 2025 earnings results.
Yep, just came out. And our job really is to cut through the noise.
Exactly. We'll pull out the key insights, explain what they actually mean, and, help you connect the dots for the wider market.
Basically, give you the high-value takeaways without needing to sift through, everything yourself.
So let's jump right in. Bank of America Q2 2025. What's the overall feeling? I'd say pretty solid, right?
Oh, definitely solid. Consistent performance, clear momentum in some really key spots.
Okay, let's get into some numbers then. What jumped out at you?
Well, revenue first came in at $26.6 billion. That's up 4% from last year.
Okay, decent growth there.
And net income, $7.1 billion after tax. Earnings per share, daily 89 cents. Both of those were up 7% year over year. So, healthy increases.
But the big one, the one everyone watches, is net interest income, NII. How did that look?
Record territory, $14.8 billion. That's 7% higher than Q2 last year.
Wow.
And importantly, it's the fourth quarter in a row that NII has grown. That's significant.
It really is, especially given the rate environment chatter shows real strength in their core banking.
Absolutely. It suggests they're managing deposit costs well, getting good returns on their loans. It's a strong signal.
And they're giving a lot back to shareholders too, weren't they?
Oh, yeah. Big time.
Yeah.
$7.3 billion returned just in Q2.
How did that break down?
$5.3 billion was share buybacks and $2 billion in dividends.
Okay.
And if you look at the first half of the year, the total capital return is $13.7 billion. That's like 40% higher than the first half of 2024.
20% higher. That's aggressive.
It is. And they're planning an 8% hike to the quarterly dividend starting in September.
Okay.
Assuming the board approves, of course.
Okay, so strong results, record NII, hefty capital returns. Let's dig a bit deeper now. What's really driving this performance?
Well, the good news is it seems pretty broad-based. They mentioned strong organic growth across really all their main businesses.
Any standouts?
Markets-related revenue definitely gained momentum. It was their 13th straight quarter of year-over-year sales and trading growth, up 15%.
13 quarters, that's quite a streak.
It is, and investment banking fees also picked up, hitting over $1.4 billion. They said it actually improved as the quarter went on.
Interesting. What about the bread and butter? Deposits and loans.
Deposits, average deposits have grown for 8 quarters straight now.
8 quarters, that speaks to maybe sticky customer relationships. Disciplined pricing?
Probably both. They certainly highlighted disciplined pricing. And total assets are up too, $3.44 trillion. That's up $92 billion just from Q1.
Driven by what, mainly?
Strong loan growth, mostly, and also more client activity in global markets. Loans overall were up 7% year over year, hitting $1.13 trillion.
And commercial loans led that charge.
Yeah, commercial was up 10%. So businesses are still borrowing.
Okay, growth is great, but you got to manage costs too. How are they doing on the expense side?
Pretty well, actually. Expenses came in under $17.2 billion. That's almost $600 million lower than Q1.
Any particular reason for that drop? Is it sustainable?
Well, part of it was seasonal, no big payroll tax hit like in Q1, and litigation costs were a bit lower.
Okay.
But management also stressed headcount discipline. They're down to about 1,500 people since the start of the year, not counting interns.
So maybe some structural efficiency gains in there too, perhaps driven by tech.
That definitely seems to be the underlying story, yeah. We'll probably get more into that.
And crucially, is this efficiency hurting asset quality? Or are loans holding up?
Asset quality looks pretty sound, actually. Net charge-offs have been hovering around the $1.5 billion mark for like 6 quarters now.
Stable.
Right. And they said most of those were already reserved for, so the hit to profit wasn't huge.
What about the problem areas we hear about, like commercial real estate office?
Yeah, CRE office charge-offs were elevated. That's consistent with what we're seeing elsewhere.
Yeah.
But consumer net charge-offs were actually lower. And interestingly, the net loss rate on credit cards went down year over year. Apparently, that's the first time that's happened since like early 2016, if you exclude the pandemic weirdness.
Wow. Okay. So consumer credit quality improving.
Seems like it, yeah. And C&I loans, commercial industrial, the loss rate there was tiny, just 9 basis points. Very strong.
And all this is built on a strong capital base, right? How are the ratios?
Very strong. CET1 capital is steady at $201 billion. That gives them a ratio of 11.5%, which is well above the minimum requirement.
And the stress tests, CAR?
Yeah, their calculated stress capital buffer from CCR is 10%. That takes effect October 1st. It just reinforces that they've got a solid foundation.
Okay, let's shift gears to what management was saying, their outlook. What's their take on the macroeconomy?
Surprisingly optimistic, maybe. Their research team is sticking to the no recession call. Still, they see modest growth, maybe 1.5% by year end, and they don't expect the Fed to cut rates until next year.
That's definitely a bit more positive than some forecasts out there. What are they seeing that supports that?
They're pointing to solid consumer spending, improving credit quality like we just discussed, and strong household finances. Good net worth, good account balances.
Okay. And how are they driving growth internally, that organic growth strategy?
It's really impressive across the board. Consumer banking, for instance, they hit 5 million net new checking accounts over the past 6 years.
5 million net new? That's huge.
It is. And average balances in those accounts are over $9,200 now. Plus, digital engagement is massive. Nearly 80% of households are digitally active.
Wow.
4 billion logins in Q2. And get this, 65% of consumer product sales happen digitally.
65%. The branch is definitely changing.
Absolutely. And it's similar in wealth management. Client balances hit $4.4 trillion. They pulled in $82 billion in AUM flows over the last year, added over 7,100 net new relationships.
Strong numbers. Global banking, too.
Yep. Solid client activity there as well. Added over 1,000 net new clients, mostly driven by their payment services.
Okay, you mentioned tech earlier. Let's circle back to that. The AI strategy. This seemed like a really big theme on the call.
It really was. And the scale is just staggering when you think about it.
How so?
Well, they talked about headcount. Over 15 years, they've gone from around 300,000 employees down to 212,000. That's almost 90,000 people.
And that's not just trimming fat, is it?
No, they frame it as the direct result of relentlessly applying scalable technology and digitization. It's a fundamental shift.
And AI is the next phase of that.
Exactly. They see AI working across 4 main areas. AI agents like chatbots, search and summarizing information, creating content, and then automating coding and processes.
They have that virtual assistant, Erica, right? How's that doing?
Erica's huge. Introduced back in 2018, believe it or not, now handles over 58 million client interactions a month.
58 million.
Yeah.
Incredible.
And it's internal too. 90% of their own staff have used Erica for employees for things like simple HR tasks.
So it's really embedded.
Deeply. And they've got 17,000 programmers using AI coding tools, saving 10-15% on code generation costs. They hold 1,400 AI patents, built over 250 AI models. I mean, the scale is immense.
But they stressed applying it responsibly, right?
Very much so. They emphasize applying it effectively at scale, but also making sure the decisions are right because, it affects people's finances, their lives.
Okay, so with all that context, strong NII, tech focus, what's their outlook for NII going forward?
They're sticking to their guns. They expect the NII exit rate in Q4 this year to be between $15.5 and $15.7 billion.
Same guidance as before.
Yep, unchanged. And they think growth will actually pick up pace in the second half of the year.
Why is that?
A few things. Fixed rate assets repricing higher, continued loan and deposit activity, and interestingly, some benefits from lower rates in their global markets businesses. Put it all together, they see full year NII improving maybe 6-7%.
And what about capital? How are they thinking about using that strong base?
Well, they feel a buffer of about 50 basis points over the regulatory minimum is appropriate.
Okay.
And the plan is to use any excess capital for, growth in the core businesses, but also continuing the shareholder returns, dividends, and buybacks.
Do they see any limits on where they deploy capital, like in global markets?
They said there's no theoretical ceiling on allocating risk-weighted assets, RWAs, to businesses like global markets, as long as those businesses generate good returns. It's purely driven by return potential.
Did anything else catch your ear? Any newer topics?
Yeah, they briefly talked about stablecoins, which is interesting.
What's their view?
They see them as a potential new payment rail. They said they're ready to support clients if the demand is there. They kind of compared it to how they jumped on Zelle early.
Right. Zelle's massive for them now.
Exactly. But they also stressed, they need legal clarity first and real business use cases. And they pointed out that most of their money movement is already digital anyway.
Makes sense. Anything else specific?
Just a quick note on clean energy investments. New tax rules are apparently going to slow down their wind and solar portfolio after 2027. It'll gradually wind down by 2033.
Will anything replace that?
They expect to keep investing in lower income housing, but probably not enough to fully offset the drop in clean energy stuff.
Okay, so pulling it all together then, what are the biggest takeaways for you from this call?
For me, two big things stand out. First, that really strong, consistent NII growth. It shows their core banking model is working incredibly well, even with rate uncertainty.
Yeah, resilience.
Right. And second, the sheer scale and impact of their technology and AI investments. It's not just talk. It's fundamentally changing how they operate and engage with customers. It's a huge efficiency driver.
So zooming out, what signals does this send to the broader market?
I think it paints a picture of a surprisingly healthy U.S. consumer, maybe more resilient than feared. It underscores that digital transformation isn't optional anymore in finance. It's critical.
And it highlights the ongoing sort of nuanced issues in commercial real estate, even while other areas are strong.
Exactly. And it shows how these huge established banks are really leveraging AI not just to cut costs, but as a genuine competitive weapon.
Which raises the question, looking at that balance, BofA is striking tight cost control, but big tech investments. What does that mean for everyone else? Can other big banks keep up with that kind of spending and strategic focus?
That's the key question, isn't it? It really puts pressure on competitors to demonstrate their own paths to leveraging technology for sustainable growth.
Okay, let's shift gears for our This Is Not Financial Advice segment. Purely hypothetical, thought-provoking trade ideas here.
Disclaimer noted.
All right, so based on this call, what's an outrageous but plausible idea?
Okay, how about this? You look at BofA's clear lead in AI adoption, the headcount reductions driven by tech, that strong NII from the consumer side. You could build a pairs trade. Go long Bank of America, betting on that AI-driven efficiency and their consumer engine continuing to fire.
Okay, long BofA. What's the other side of the pair?
You short a competitor. Maybe a large legacy financial firm that seems, well, a step behind on the AI front. Perhaps one with more visible struggles in commercial real estate, where both of themselves flag some stress.
So the thesis is basically AI winners versus AI laggards in finance.
Pretty much. You're betting that AI isn't just a buzzword, it's creating real separation. It drives efficiency, improves customer experience, and ultimately boosts the bottom line for the leaders, potentially at the expense of those slower to adapt.
Interesting. Betting on that tech differentiation becoming even more critical.
Exactly. Again, purely hypothetical, not advice.
Absolutely. So let's wrap this up. Key takeaways from Bank of America's Q2.
Sustained organic growth. That record NII is huge, and a really powerful, tangible commitment to using technology and AI to drive efficiency.
Plus, consistent capital returns, disciplined risk management, solid asset quality overall. They seem strongly positioned. And it leaves us with a final thought to chew on. We see AI drastically changing BofA's operations, from staffing to how they talk to customers.
Yeah.
So beyond just one bank's balance sheet, how could AI completely reshape the entire competitive landscape for finance over the next, say, 10 years? What will efficiency or customer experience even mean in that new world? Something to think about.
Definitely something to think about.
Okay, that's our deep dive for today. Remember, everything we discussed is for informational purposes only. It is definitely not financial advice.
Please do your own research and analysis.
Thanks for joining us.